Hello, and welcome to another TMRN, Time Monk Radio Network production. I'm McLaren, and today is Saturday, the 14th of April, 2012. Joining us today for a discussion of economics, finance, derivatives, and where money and markets may be flowing is Michael J. Panzner. Michael is the author of When Giants Fall, released in February 2009, Financial Armageddon, published in May 2008, and The New Laws of the Stock Market Jungle, which was published back in 2004. He has been a columnist for TheStreet.com's Real Money paid subscription service and is a contributor to AOL's bloggingstocks.com. Michael has appeared on or been quoted by CNBC, Bloomberg, The Wall Street Journal, USA Today, Barron's, Reuters, CNN, and other print, radio, and television outlets. He's a 25-year veteran of global stock, bond, and currency markets. During his career, he has worked in New York and London for leading companies such as HSBC, the Soros Funds, ABN AMRO, Dresdner Bank, and JP Morgan Chase. He is a New York Institute of Finance faculty member specializing in equities, global trading, capital markets, and technical analysis. Hello, Michael, and welcome to the Time Monk Radio Roundtable.
Well, thanks for having me. Looking forward to it.
We're very happy that you're here with us this evening. The Time Monk Radio administrator is Fox, and today he'll be doing the recording and technical support of the show. Several members of Time Monk Radio Forum were kind enough to join us for this discussion. They include members Giuseppe, Ruski, Shibumi, and Skyhenge. For listeners to this interview, we are assuming you have a fairly good understanding of Michael's writings and the premises that underlie his thinking. His website can be found at financialarmageddon.com. This radio interview will be available for free at timemonkradio.com, on YouTube at the Time Monk Radio channel, and at the website webbotforum.com. Are you ready to begin, Michael?
I certainly am.
Terrific. This interview has been arranged around several topic areas, the first of which is debt. Since you wrote the book before the devastating plunge in 2008, debt has grown hugely owing to stimulus spending, bailouts, continuing social support spending, weak tax collections, and a myriad of other financial and fiscal causes. Keynesian economists, including Ben Bernanke, suggest this expansion of the public sector debt prevented the economy from falling into the next Great Depression. Since then, debt has grown and continues to grow. How far has the proverbial can been kicked? The so-called bond vigilantes haven't been spotted in a very long time. Is it possible that the Fed can continue to just monetize the debt given the liquidity trap that the financial system is mired in?
Well, in a way, the answer to that question is that it will carry on until it can't. One of the premises of my book was that the whole crisis would play out in a way that would really be sort of two phases. The first phase, which I think we've all been living through to a certain extent still, although the most dramatic parts of it were, back with the Lehman failure, was that we would see the real sort of fallout, I guess you could say, from this tremendous bubble that had built up, both in terms of debt and in terms of other obligations, which I also discussed in the book. And that the approach, at least at first, would be sort of traditional. There would be an element of measured response that would gradually escalate, but ultimately that the I guess after, to use your term, a degree of can kicking, we would sort of cross the Rubicon, so to speak, and that we would suddenly find that central bankers had really lost the plot and that we would move into an inflationary phase. So I think the answer, in a sense, to your question is that they have managed to kick the can, and things do seem to have a sort of a calm and a quietness to them. But the reality is that it sets the stage later on for them to be in the trap of continued printing and ultimately to a destruction of the currency.
Okay, so it was a deflation first, inflation second. We just haven't quite reached the inflation segment yet. And that makes perfect sense. It's kind of how I anticipated things would play out as well. Our next question will come from Giuseppe.
Hi.
Hey.
I'm just going to ask the question, if you don't mind.
Sure.
The argument of which will it be, inflation, deflation, or both, I think may merit a new way of looking at this subject. In Germany's Weimar Republic, inflation ate up the value of their money because the powers just printed and printed until the economy was sloshing around with too much paper money. And so the economy was subjected to the laws of supply and demand, obviously. On the other hand, in the U.S. Depression, as I understood it, the opposite happened. There was a lack of paper money. So its worth became increasingly valuable. My question basically is, today's money is mostly created and destroyed digitally, with the central banks having this new control mechanism extending their ability to inflate and deflate the system almost at a moment's notice. Does this not negate the inflation-deflation argument of old?
Well, it does to a certain extent, but in some ways you're saying, well, this time is different, and I don't think this time is different at all. I think what it does is, and it's a factor, I think, in the financial crisis. It's been a factor in the evolution of markets. I think it tends to speed things up, and the whole world, in a sense, is moving faster. But my belief is that all we can see here is in Weimar times, for example, it took a period for that whole crisis to play out and for the end game, the hyperinflation, to occur. I think the moment, the turning point here could come rather more dramatically because, you have people who are investing in the U.S. market, whether they're domestic investors or whether they're overseas investors, who could quickly lose heart, who could essentially pick up a phone or tap on a computer or use a system of some sort to try and get out of their position, whether it's in the currency or whether it's in the fixed income markets, et cetera. They could do a rapid stampede for the exits, and at the same time, you also have the inability in the sense that even though the Fed could, in theory, rein in money supply and dampen inflationary expectations more quickly than in the past, you still have essentially what are policymakers making decisions that are going to be somewhat measured, and they're going to be reacting after the fact. They're going to be moving after markets have already started pushing them in the way that they don't want to go. So I guess my point is that ultimately the outcome that I see is higher inflation and, in fact, a complete destruction of the currency. The reason being that we will have already set the stage, and the process is going on right now. We have already set the stage for a degree of expectation about further Fed easing and a political ensnaring of the monetary mechanism, which is really how you get hyperinflations. I mean, most people tend to sort of lump traditional inflations together with hyperinflations, and they're really two different animals. I mean, traditional inflations are probably a little easier to understand. You know, you have too much money to a certain extent, creates excess supply, tends to push up prices. But in a hyperinflation, and certainly in the kind of environment we saw in Weimar and the kind of environment we saw in other hyperinflationary episodes through time, you have a loss of faith in authorities, whether it's the monetary authorities, whether it's the fiscal authorities, whether it's both. And in fact, right, you know, traditionally you get a sort of co-opting of central bank policy by the fiscal authorities. Basically, they lose their independence and they start to exist solely for the purpose of keeping the government Ponzi scheme going. But ultimately, it represents a loss of faith, and the reality is that you can have, like we have at the moment, a very low velocity of money, all this cash sitting there doing nothing, not causing any, quote, traditional inflation, and then all of a sudden people don't want it, and that supply that's been sitting idly by comes into the marketplace and has a dramatic effect on asset prices of all kinds, as well as the moves in the currency itself. So I do think you have to distinguish to a certain extent between a traditional inflation and a hyperinflation, and also bear in mind that although we're not going to see printing presses in a literal sense, we have actually seen the capacity for government to create digital money, we've already seen just a taste of what they're capable of, and I think that taste could grow dramatically and lead to essentially beyond the point of no return. So I don't know if that answers your question, but my overall perspective, and I think the one that is important and really was the sort of backdrop of why I felt that we would see ultimately bad news for the dollar and bad news for the U.S. is a loss of faith in the U.S. In the U.S. Economy, the U.S. financial system, and the people who are running the government.
Yes, that does answer my question. I was going to have a follow-up, but you kind of answered it. So I'm going to continue with a question from Green Meadow, if you don't mind.
Okay.
Okay, so more and more programs are government guaranteed, which really means taxpayer guaranteed. But the taxpayer is not doing so well. Greece's taxpayers are paying for interest on loans that they don't want and that they don't actually have the money to pay. What happens when the taxpayer is broke?
Well, there's a couple of answers to that. The issue is whether governments approach it from the point of view of austerity, which is a necessity in the case of Greece because they can't print their own currency. I mean, they're essentially the biggest problem in Europe now and the biggest argument, I guess, for why the U.S., quote, won't default in the sort of literal sense is that the U.S. can print its own currency. Most of its debts are accumulated in dollar terms. So in a sense, they can't. It's probably impractical to think that they're going to outright default because they don't need to. They can just print more money. Whereas in the case of Greece and other members of the European Union or the Euro, more specifically the Eurozone, most of the debts they've taken on are denominated in a currency that they don't actually control, which is the euro, where they essentially have these obligations, but they have no way to actually come up with a workaround, or at least no direct way to come up with a workaround other than actually defaulting on the debt. So that's the sort of first point to bear in mind is that the real key question in any kind of a over-leveraged situation is what are the possible responses? And in the case of the U.S., they do have the option of printing more money pretty much at will, which is not an option that's available to many other borrowers nowadays, including Greece, for example. And right now, we're talking about problems in Spain and Italy, et cetera. So that's the first point. In terms of the taxpayer element, well, I think that's one of the key themes of my book, Financial Armageddon, but also of my last book, When Giants Fall, was this linkage between social conditions and economic conditions. The reality is that when economic conditions are poor, it increases the likelihood of social and political instability, and I think we're already seeing that right now in Europe. I think we've had sort of echoes of it in the headlines I talked about. Greece is burning. We're certainly seeing a sense of despair and a sense of resentment and anger where I think as it sort of moves on and as the sort of number of countries in financial facing financial challenges increases, which it is and it will further, more and more people are going to say, this is not our problem. We didn't make this problem, and we're not, we don't want to deal with it. Arguably, you could argue one way or the other whether they did because they voted for the electorate. But the point is that people at this point are going to say, this is not our problem, and if you don't do something about it, we're going to do something about it. And I think that's the sort of mindset that's coming along right now. And a key theme really for me, and one of the reasons I get nervous just in general terms, is that I believe that the level of violence, whether you're talking about domestic violence, civil unrest, or whether you're talking about sort of potential civil war, or you're talking about cross-border conflict of one sort or another, I expect to increase. In fact, one of the third chapter of my last book was called The Future of Violence. And my belief is that we've been through a very, very dramatic period in the sense that we've had tremendous peace in the world for, going on 6 decades. There's obviously been wars going on, but since World War II, we've had a remarkably low level of conflict in historical terms. Part of that has been because economic growth has been booming around the world for most of that period. I think there's a relationship between them, and history suggests that there is. And my view now is that the changing economic landscape will have adverse consequences for the political landscape. So to get back to your original question, are people going to be, are taxpayers going to accept this? No. How are they going to deal with it? I think there'll be a variety of approaches. In some areas, it'll come right down to anarchy. In other areas, it'll come down to different sides pitting themselves against each other, either in support of or against the government. And in other cases, you're going to find there's distractions. Governments will try to either launch some kind of conflict or some kind of attempt to divert attentions by attacking other countries. So my view is that one way or another, the social atmosphere is going to get to worsen, primarily as a result of economic circumstances, and that you're going to get a situation down the road where more and more unhappy people are going to take to the streets and do something about it.
Michael, as a follow-up question, if you don't mind,
Sure.
What can you give us your take of the states of the Union or of the United States, what they would be going through because their ability of not being able to print money? Just an overview of what you think will happen with the states, because there's a lot of them that are in trouble at this point.
Sure. I mean, to a certain extent, the U.S. is a complicated puzzle, because you're going to have some people, by virtue of their size, their political clout, at least now, their political clout, some states, for example, will be able to get some sort of a backstop from Washington, so that the states' problems become the federal government's problems. In other parts of the country, you have a traditionally more divided sense of loyalties between state government and federal government. In certain areas of the country, you have a sense that no government is good government, or at least less government is good government. So it will be varied, in my opinion, and part of it's going to be an accident of fate. One of the things I noticed recently, that in certain places such as the Midwest, there seems to be a lot more sort of anarchic type developments taking place. Flash mobs, gangs coming together to rob stores and rob people in a very sort of aggressive and frightening manner, which you haven't necessarily seen in other parts of the country. So, to a certain extent, it's probably just an accident of fate, where the sort of bad elements are, where there's a traditional respect for government, where there's a traditional sense of where the boundaries are drawn, where the economic resources of the country are. In some ways, I mean, I'm from the New York area, and I think New York could be a very vulnerable place, like many urban centers. But the reality is that at least for now, it's a very important economic region for the country as a whole. To a certain extent, Washington depends on what goes on in Wall Street to get this whole sort of debt refinancing process going. So there could be elements of backstopping going on here that benefit New York in some way, in a way that other states don't benefit. But generally speaking, I think that as we saw in the Arab world, there tends to be a contagious effect from when people see, if they see their citizens of another country rising up against inequality, for example, against corruption, against not having enough food to eat. Well, it does tend to be somewhat contagious, and especially in an age where news travels fast, where you have electronic access to all sorts of communication systems. So it's very realistic to think that in the U.S., if things started heating up, people are going to be reading about it, and they're going to start, and some are going to think, well, we want to do the same thing. And although it kind of flamed out a little bit, the Occupy Wall Street movement, in a sense, was, I think, a taster of things to come. It started, essentially right at the hub of the financial center, but did spread out and did impact other parts of the country. And I think that kind of thing will become more and more commonplace.
Michael, thank you for your answering the questions. I really appreciate it.
Okay.
Yeah, Michael, in your book, debt was one of the threats that were out there. We'd like to now examine some of the others that you had written about. In Financial Armageddon, you wrote about the retirement system. It's composed, of course, of many different elements: private pensions, IRAs, 401ks, 403bs, state and local pension plans and systems, and, of course, Social Security. This is, within this, the debts, public and private, are the assets of these investors and investment vehicles, in addition to equities, REITs, real estate, commodities, and other real assets. It's pretty clear to some observers that the public sector pension plans are seriously underfunded, and that most individuals are well below their target levels or their run rates for asset accumulation to support all but a most meager of retirements. In what other ways do you see the retirement system as a threat?
Well, I think the most important is a demographic issue. To a certain extent, I think it's not uncommon knowledge that the population of the U.S. is growing older, as is the case in many Western countries, Western developed countries. So it sets the stage potentially for a major generational conflict. You have a falling number of workers supporting a larger number of old age retirees and those who may not be able to look after themselves because of sickness or incapacity of some sort. And that problem, I guess you could call it the gray tsunami, has a number of potential implications. I mean, you talked about sort of the assets that people hold in the retirement system. Well, it's clear that as people get older, they're going to be selling things. They're going to be selling riskier assets to take up, less risky assets. They're going to sell assets to fund their living expenses as they sort of live out the rest of their lives. And they're going to be selling these to a contingent of the population that is going to be shrinking proportionally to the size of the population as a whole. So right then and there, that creates a potential, potentially a very negative, very bearish investing climate going forward. But the other side of it is that you're going to have a lot of people, and I think we're seeing hints of that now with the student loan bubble that's built up. But you're going to have a lot of people who are younger people saying, you know what, we got cheated. We got cheated because we had to pay so much more for college than our parents and our grandparents did. We got cheated because so much more of our income taxes are going to pay for people who are older than us and who should have put sock money away for retirement. We got cheated because we can't have the same luxuries they had because, in a sense, their policies helped lead towards a debasement of the currency and led toward a debasement of quality of life. So I think all of that could add up to a situation where young people are in a growing conflict with their parents' generation. And for me, that again is another element of potential social instability down the road. The other side of that coin, I guess you could say, is that there may be greater attempts to grab resources from other places to meet the needs that can't be met by domestic labor force. So again, there's a potential impetus there for cross-border conflict. And you also have this, historically there's been a relatively strong link between the growth of economies and the growth of the segment of the population, the working age segment of the population. So arguably, you may be looking at a scenario as young people shrink proportionally speaking to the size of the entire economy, where it acts as a depressant on economic growth, which exacerbates whatever woes might exist to begin with. So those are, in my mind, the sort of primary issues. Clearly, when I wrote my book, I made reference to four different categories. I talked about debt, I talked about the retirement system, I talked about government guarantees, and I talked about derivatives. But even though I sort of identified them as four separate notions, I mean, the reality is that they all represented claims. They all represented obligations that would not be met in one way or another. And really, when you talk about the retirement system, it's just another kind of debt in a sense. Except in this case, it's what makes it particularly heinous is the fact that it wasn't really accounted for properly from the very beginning. I mean, it's very easy for state governments, for example, to make all sorts of commitments to public sector employees without having to account for it until only recently. It's only been the past, I can't remember when the law came in, but only been the past year and a half or 2 years or so that municipalities have had to account in an accounting sense for the obligations they have to the retirees, to the public sector retirees that used to work for them. And the numbers are pretty frightening. You also have all kinds of unintended consequences from policies which on the one hand were designed to smooth the potential disruptions that might occur as a result of funding retirement plans. I'm speaking specifically of defined benefit plans, which have really obviously fallen by the wayside. But the point is that companies were able to game that system and put less money in than they should have, and now it's coming home to roost that those private pension fund plans are underfunded. So you really have a combination here of all of these obligations that built up over time, which was really the sort of inspiration for me writing the book, to be honest. Coming at the same time that certain forces, certain elements, for example, demographics, were going to make the prospects for growing out of those obligations that much harder. And not to mention the fact that the sort of whole idea that once you get past a certain point in terms of interest expense, there's basically no chance they're ever going to pay that money off. And I think we're rapidly approaching that point if we haven't already. And when that comes, it changes the game completely. Whether you're talking about retirement obligations, whether you're talking about current debts, whether you're talking about guarantees that the government has made, whatever the case, the fact that we're hitting a point where it suddenly becomes acknowledged that there's no chance that we're going to pay this money back. It leads to the next crisis, in my view.
Yeah, no, I agree with everything that you've said there, and the demographic wave is certainly approaching shore much more quickly than anybody had anticipated, especially the politicians.
Sure.
Yeah, we've just discussed some of the government's guarantees in terms of pensions and Social Security. Most of the analysis that I read points to Medicare and Medicaid as being the most proximate of the insolvency candidates, if the FDIC isn't included because the banks are all fixed now. Then there are the continuing subsidies and nearly explicit promise of backing for Fannie and Freddie given their conservatorship. The promises just keep extending. I agree. But together, Ben Bernanke and Tim Geithner have a digital equivalent of an endless printing press. And since they're not linked to paper, deforestation isn't a problem, and I don't think ink is either in that case.
Right.
So I ask, dripping with sarcasm, what could possibly go wrong?
No, it's interesting that you say that, and I think that, and in fact, again, it wasn't just the scale of the obligations that had been built up, which is pretty frightening, actually, and I'm sure many people were aware of them. But what bothered me most of all, and I think that's the mindset you're describing here. I know you're saying it sarcastically, but the mindset that you're describing is the fact that people didn't think it through. They didn't think that somehow, even though they thought it was unsustainable and untenable, that it was that it wouldn't end badly. And I think that's the biggest thing that got me in terms of actually putting that book together, was the fact that everyone thought that this was just going to carry on and work itself out. And there was just you just had to look at the numbers on paper and say there's no chance of that happening. And I think the same situation applies now, is that there's a sense of, well, we can keep, the government can keep spending money it doesn't have, and the Fed can keep creating money it doesn't have to finance, that spending, and ultimately it'll all work itself out. And nobody looks, for example, at the fact that the Fed has built up this tremendous balance sheet, but the only way you can avoid, if you like, the nightmare loss of faith to a certain extent, is that the Fed is able to sell those securities back into the market. Because once it becomes clear to people that those securities the Fed bought those and they're never going back into the market, then you have the acknowledgement that you've had full-scale monetization taking place. Right now, there's this sort of faint hope that if conditions improve, then the Fed can gradually wind down its balance sheet, and therefore it did a good job of temporarily providing assistance to support the system. But the truth is that if you get past a certain point, it's a bit like recognizing a bad debtor. After a certain period of time, accounting rules force companies to write off debts. Except, I guess, if you're a too big to fail bank, then you can do whatever you want. But generally speaking, accounting rules force companies and force creditors to write off debts after a certain period of time, because it becomes essentially self-evident that they're never going to get to pay those debts back. And I think that's the same kind of logic that will apply in the sense of understanding what's been going on with the Fed. That up till now, there's still a broad enough belief, obviously not everyone believes it, but a broad enough belief that they will be able to unwind the purchases that they've taken on, and that we will all look back in hindsight and say, great job, Ben, thanks for bailing out the system. Now we can get back to normal. But the underlying assumption there is that they're going to be able to sell, wind down and sell those assets that they've bought over the course of the past, 3 years or so at a tremendous pace. They're going to be able to somehow sell those to people in the market at the same time that you have these sort of, for example, demographic pressures going on, which are gradually creating selling pressure, and at the same time that you have in my view, a slowing economy, which creates other kinds of selling pressure that will essentially translate through to the financial market. So it's just mind-boggling that people don't think this through and think that, wait a minute, at some point, if you borrow enough or if you buy enough, it's a bit like the Hunt brothers trying to corner the silver market. Yeah, the game is great as long as it's going on, but at some point, when they can't buy anymore, or when their conditions change for one reason or another, then the bottom falls out. And I think that's exactly what's going to happen in terms of this whole idea that the Fed has rescued the system. It's going to turn out to the Fed has destroyed the system.
No, I agree with you. It was bad enough before. Now that they've entered and completed or nearly completed Operation Twist 1, they've certainly lengthened the duration of the Fed's portfolio. They have not made things any better and have likely added into the possibility that things can dislocate in a way that we're certainly not expecting. For the next question, I'd like to bring in Sky Henge to the conversation. Sky Henge?
Thanks, Mac. Hi, Michael. It's great to be here speaking with you today.
Thanks.
I have a question from Green Meadow regarding Medicare. Medicare has become quite the mess. Politicians know it would be suicide to end it, so they seem to be whittling away at it. People still have Medicare, but it does not cover X, Y, Z anymore. Also, because of cuts of payments to doctors, you may have Medicare, but you can't get a doctor. Medicare is insolvent as it is, and it is probably also insolvent under Obamacare, but the insurance companies will make out better under Obamacare. What do you see happening with this situation, and what should the people be doing in this situation?
Well, one premise of my book, in fact, one premise of my last two books, was that it's going to become a world where people have to be much more resourceful and much more dependent on themselves, their families, their communities, and really those who are in their sort of circle, in a way that probably takes us back a couple of hundred years to the sort of olden times, not to sound like some kind of a hick here, but to times when people had to look after themselves. So I do think that is one likely development. There will be some people who luck out, some people who are, manage to die before they don't need insurance anymore. I know that doesn't quite sound like luck, but the point is that it's going to become harder and harder to sustain the Medicare, which, at least in the way it's structured. I think, to be fair, the other side of the coin is that ultimately that political pressures and social pressures will force something of a change. I mean, there'll be raising of retirement age, there'll be a scaling back of benefits, there'll be probably some kind of single-payer type system, whether the insurance companies like it or not, because politicians are going to say that if I don't change this now, I'm going to have the people with pitchforks coming after me. So I think the insurance companies could lose out dramatically in the short run, and you could find that the system that they do get some kind of a handle on costs that provide some sort of short-term relief. But longer term, the system's broken, and it's really just a question of whether you get your share of the benefits and die before the benefits run out. And I know that sounds kind of harsh, but I think that's the way it's going to play. And I think you're already seeing now in terms of the rest of the economy that there's an increasing sense of dependence on family. I mean, you have lots of more stories now about children and grandparents and parents all living in the same household. Part of it's economically driven, but it's not. To me, it's not surprising that we will. I wouldn't be surprised to see a lot more of that going on with other factors influencing it, including the cost of medical care. But frankly, the same thing with the whole economic crisis. One of the questions I got asked originally when the book came out is, okay, so let's say we buy your scenario that the world is going to hell and that this is all, the results of bad policies and bad decision-making that were decades in the making. What can we do now to fix it? And my view then and my view now is it's not really fixable. I mean, the only thing that can really fix anything at this point is time. And the only thing that government intervention has done is extend the amount of time it's going to take to fix the problem. I mean, clearly nobody likes an ugly Great Depression, which, arguably we could have had one of those already underway. But, the truth is, do you want to have a situation where you are living in a prolonged hell for decades on end, or do you just want to bear the pain and get it over with? And I think, historically, whether you're talking about private enterprises or whether you're talking about some governments that actually managed to cope far better with the financial crisis than others, and I'm pointing to the Swedish model, if any of you are familiar with that. But in the late 90s, in the early 90s, the Swedish banking system had a fairly severe financial crisis, and they took the approach that it would be better to essentially deal with this straight up, to shut down all the bad operators, backstop the depositors, fire all the people who caused those problems, and essentially save the system. And in a sense, that's what happened well, that's what should have happened here. But back then, they had a tremendous financial fallout afterwards. The economy went cratered. It really looked bleak for a time. But once they were through that sort of process, the Swedish economy recovered dramatically. And in a way, we're seeing something similar, for example, in Iceland, where there was a sense that it's better to just bite the bullet and deal with the consequences of default and deal with the consequences of the financial mess rather than trying to pretend it's not there or pretend we can overcome it. And I think ultimately that's my perspective on many of the financial issues that we're dealing with right now, is that because people have deluded themselves into thinking they could fix it, they've only ended up making things worse. I mean, another example. In fact, one reason why I feel that the next down leg, which I believe is probably fairly imminent, is going to be so much worse is because so many parts of the economy, whether you're talking about the government in Washington or state governments or media or Wall Street, whatever, kept telling people that things are going to get better, that we have it under control, that the situation is not as bad as it seems. And what that did is it reassured a lot of people who don't know better to thinking that, well, maybe that's true. So they didn't save as much. They didn't rejig their lives. They didn't think about changing careers. They didn't do any of the things that could have made their lives a little bit more prepared for the financial problems that still remain. And so in my view, it's one reason why, for example, I don't think personal household debt, credit card debt, for example, hasn't gone down that much. Partly it's because people don't have the money, but it's also partly because people think, well, I'll just ride this out for now, and then when things recover, I'll be back on my feet. And so in a sense, the government approach has it actually made the underlying situation far worse than it could have been. And I think the same could be said about the Medicare system not addressing the issues. The demographic problem clearly is the big issue, but not addressing the notion of reining in costs. Reining in the fact that you have this whole private sector that gouges themselves on the rest of on certain elements of the economy. So maybe if they'd addressed that sooner, it would have slowed down the sort of decline process. But ultimately, I think all of these things have reached a point of no return. So whether you're talking about Medicare, you're talking about the amount of debt outstanding, you're talking about the size of the derivative exposure, you're talking about the government guarantees that have been made, you're talking about the structural problems with the economy, the fact that, you have this huge number of people that are still in industries that are essentially finished, or at least finished relative to the way they were before, sort of finance and real estate, et cetera. So nobody's done anything to address the structural issues. And because we've moved so far along that curve, I believe the only real solution now is going to be a forced one from a crisis.
Okay. Yeah, that sounds about right to me too. It's moving toward a crisis. I have another question from Green Meadow. You had mentioned student loans.
Right.
What do you think will happen with the student loan bubble? I know someone who's 60 years old that co-signed on her niece's student loan. If the niece is not able to pay off her $60,000 debt, my friend can have the debt deducted from her wages or from her Social Security, as student loans cannot be discharged with bankruptcy. The niece got a degree in nursing and does have a good job. However, her $800 a month payments only cover the interest. She's depressed and does not want to go to work because she's making no progress, but is only able to tread water. Do you think the bankruptcy exemption can be challenged? Where do you see the student loan mess heading?
I absolutely do think it will be challenged, and I do think that it will be part of this whole anti-bank, anti-financial system backlash, particularly in the wake of all of the bailouts and all the other nonsense that took place after the world blew up. But I absolutely think it will change. How it changes is I don't know whether it's going to be in one fell swoop, but I think there's already a recognition that if we don't do something about the fact that you have this, our future, the people who are our future, the young people, in tremendous debt and already starting off on a really bad foot in terms of, getting on in their lives, there's a recognition that that has tremendously negative implications for economic growth. It has negative implications for public policy. It has negative implications for those in office, because I think you could reach a point, and again, I think it's all tied into to a certain extent to the generational issue I mentioned earlier. You reach a point where young people say, you either fix this problem or we're going to take care of you, and they don't mean that in a positive way. So I think there'll be a lot of pressure. Right now, Washington, to a certain extent, is still owned by the financial sector. They are the biggest lobbyists. They are the ones who are the paymasters. They're the ones who essentially put in place a lot of these anti-consumer, anti-good public policy measures. But I think as the sort of conditions deteriorate and as people start to say, you know what, the tide turns against the financial sector, the public outcry is going to be enough to force changes to come through. So I guess in a way I'm optimistic that, that situation will probably be resolved in the way that it should be. But why did it have to come to this point? I mean, in fact, I remember putting together a chart before the housing bubble burst, and I'm not trying to say here that I knew exactly when it was going to happen, because I didn't. But if you looked at the markets, if you looked at inflation rate over the past 3 or 4 decades, and you compared that to, say, the rate of inflation in tuition, the rate of inflation in housing, the rate of inflation in a couple of other areas, and what those smaller groups were much higher than the rate of general inflation, and the question then was, well, why are they so much higher? And if you looked at across at all of them, they were all because of government involvement to a certain extent, government policies that encouraged bad behavior, government policies that encouraged excessive debt, the free availability of capital because too much loan money being around for that people really weren't in a position to afford. But there was all this sort of lack of regulation. A number of factors contributed to too much debt being pumped into certain markets and ultimately ending up causing huge problems for those markets. And I think that is the case with housing. I think it's the case with education. When I went to school, which was 30, whatever it was, I'm losing track of time here, 35 years ago, tuition levels at the top schools were less than a tenth of what they are now, and inflation hasn't gone up that much since that period of time. And I could work during the summer and earn most of the money I needed for tuition, which nowadays just doesn't happen. So clearly there's been some kind of a disconnect, and I think a lot of it comes down to government policies that have made, for example, student loans widely available without any thought of the consequences in terms of how much money people could take on. And in fact, it addresses a point that one of your colleagues mentioned earlier. This idea that you can just keep throwing money and money and money at a problem. You can, like the Fed can keep buying and buying and buying assets. The government can keep borrowing and borrowing and borrowing. All of these things nobody ever stands back and says, but at some point the game is up. And I think that same issue, that same logic will apply to the whole student loan bubble and the whole student market. I think a lot of people are going to make a decision not to go to school. I think a lot of colleges are going to go bust. I think there's going to be a serious reappraisal of the education system, and I think there's going to be changes in the bankruptcy laws to stop an outright revolt by the young people in this country.
Good. I hope that's true too. So Green Meadows' friend whose niece got the loan, there's a chance, you think there's a good chance, because this is part of a bubble situation, that the government's going to have to look at it and consider doing something about it, like they got into the housing bubble?
Well, yes. I mean, timing is everything, and it goes back to the question about Medicare. I mean, at some point the bubble is going to burst, and there's just not going to be the resources available, at least in certain parts of the country or for certain kinds of services. But it really is a question of, how far down the road that is. I don't know for sure. And the same thing with the student loan bubble. I don't know for sure. I tend to think it's closer rather than farther. And it may well be the next election that really kicks things into high gear, but to a certain extent, it's a matter of timing.
Okay, thank you, Michael. Back to you, Mac.
Michael, as we continue our conversation, we'd like to examine a less well understood area. That would be one that encompasses MF Global's bankruptcy and the derivatives question. And in this area, our first question will come from Ruski.
Hi, Michael. By the way, this has been an awesome interview, and we really appreciate the time that you've given us today. I'm asking this question on behalf of a member of the forum, Pref1 IDEET, one of our good friends. It has to do with MF Global. After the MF Global rampant speculation has risen about counterparty risk, if an investor performed due diligence and purchased strong asset-based publicly held securities, these investments could potentially be negated by broker/dealers going bust without sufficient insurance to make the investors whole. Some countries might nationalize privately held precious resources, and there's also the possibility of bankrupt nations imposing excessive luxury taxes on any and all well-placed investments. What's your take on counterparty risk in strong asset-based publicly held companies given the above scenario?
I absolutely think counterparty risk is a big problem and will get worse. And in fact, one of the criticisms I got when I wrote Financial Armageddon, which was actually published in March 2007, the paperback came out in 2008. So the timing was right. But one of the criticisms I got back then was, you don't have a lot of investment ideas. You don't have, you should buy X and sell Y and do Z. And I said, well, part of it is because I think there's a real serious risk that whatever you do could be negated because of the kinds of issues that you just described. I mean, I think, one of the arguments about investing overseas, for example, is that, you can get diversification, and ultimately when the dollar goes down, which I think we may discuss a little later on how I see that playing out. But, the idea is that, if you have your money overseas, you're going to benefit. Well, yes, in theory, but if the government where you have your money confiscates it or creates gates of some sort, some kind of a development that, for example, says foreigners can't take their money out. Well, all the money you think you had is basically worthless if you can't take it out of the place where you invested it to use it. And I think that is one real risk. There's a tremendous number of products, financial products in the country. I can think right off the top of my head, exchange-traded funds, for example, where you have a risk to the creator of those exchange-traded funds, admittedly a marginal risk, but certainly there is a real risk, and certainly as we saw during the financial crisis, you never know what kinds of issues can suddenly be turned from being small problems into big problems, but you have credit exposure to people who package those kinds of products, people who transact those kinds of products for you. You have a greater risk, and this is something I warned about before, that a deteriorating economic and financial environment tends to lead to more fraud, tends to lead to more outright criminal activity of one sort or another, and the people that you thought you might be able to trust before, you won't be able to trust in future. So those are just a couple of the areas, but I think counterparty risk, in my mind, was a very underrated issue before the financial crisis began. I mean, certainly it became a very big issue at the time that Lehman went under, but there's a feeling now, for example, that, somehow the government, we've gotten through it and that it's all going to be better and we put all these safeguards into place and blah, blah, blah. Well, it's BS. I mean, it's not reality. We still have tremendous interlinkages between financial firms. We still have concentrated important parts of the financial system that are very highly concentrated. These are transaction mechanisms. We still have too big to fail institutions. In fact, a lot of the ones that people were worried about before are now bigger than they were then, in terms of their relative size and compared to the rest of the banking sector, for example. So we still have these risks in the system that one counterparty could fail, and that could set off a chain reaction that has that impacts your investments in one way or another. And I think there's the political risk element is highly under appreciated. I think one of the things I warned about in my book was it's all well and good to be bullish on gold, which I do believe will be precious metals will remain a good long-term investment, though in the short term I have somewhat different views. But in the long term, it's all well and good, but if you have a situation where people can confiscate that gold, or if you're invested in mining shares and the government nationalizes or expropriates their mines, particularly a government, say, in Latin America or in Africa or somewhere else, where there's, punitive taxes introduced. There's any number of things that make your seemingly good investment into a really bad investment overnight. And I think that is a risk that's very much underappreciated. So I think one of the things that financial crisis should have taught people, but clearly it hasn't taught everybody, is that there's a lot more risk in a lot more everyday types of issues than people have really come to appreciate. And I think that is the case particularly with counterparties, but it's certainly the case with any kind of investment decisions that people make. One of the sort of quotes I used from in the book was from Roy Rogers from the Depression era. Was he talked about, don't talk to me about return on investment, talk to me about return of investment. I think that kind of logic and that kind of perspective is going to become more and more important. Now, clearly, nowadays that's difficult to do. I mean, you think about the fact that government has interest rates at zero, so even if you want to buy safe investments, you basically don't earn anything on it. But my view is that it's better to earn very little and get your principal back than to sort of reach for yield and to invest in something that really doesn't make a lot of sense, and risk losing interest and principal, or risk losing capital in some form or another. So I think this issue, which many people seem to think has been resolved in the sort of post Lehman Brothers bankruptcy area, has definitely not gone away, and it certainly remains an issue for example, in the money market fund area. It remains an issue in the, as I think one of your colleagues noted earlier, with the FDIC. Clearly, the structure of the FDIC makes it more difficult that it will become, makes it less likely that it'll become a problem down the road. But it doesn't mean it can't happen. I mean, there's just no real understanding of reality behind that statement that FDIC is, there's nothing going to happen with your deposits in the banking system, because it all depends to a certain extent on an element of confidence and an element of faith in the financial system and in government that could disappear overnight. So getting back to your issue, I think it's still, despite everything that's gone on, an underappreciated risk, which will only get worse going forward.
That was a very good answer. In fact, I felt that your section on derivatives risks was one of the absolute best in your book in 2007. And frankly, you did save me some money, by the way, because when I had bankers trying to force certain products, promoting certain derivative products, I recall what you said about the underappreciated risks, and I didn't go into that. And now I look back and realize that I would have been shorted. I would have lost quite a bit of money. So anyways, I just like to follow up and just ask you, how do you view derivatives risk in light of MF Global? Like, what do you think the impact of MF Global is? And is that an example of derivatives risk gone wild?
Well, to be honest with you, I don't claim expertise on the MF Global situation. But my general view is that it's actually less derivative risk and more an element of a captured regulatory mechanism. In other words, that you had essentially governments that were supposed to be enforcing rules designed to keep customer deposits safe, not enforcing them or allowing the rules to be changed in such a way that they made a mockery of them. I mean, the truth is that it wasn't really a derivative type play that cost MF Global they caused MF Global to go under. It was that they used customer funds, whether you accept it literally or whether it was done sort of indirectly, but they used customer funds to generate additional money, and the way they did that was by investing in risks that turned out to be much riskier than they thought, the European government bond market. So in a sense, the fact that these firms, A, were allowed to do that, and B, were not held accountable and still aren't held accountable for those kinds of disregard, I guess you could say, of client money, is the real issue. I mean, to be honest, I don't think it's a big derivatives deal. I think the real issue there was that this money was supposed to be kept in the safest possible form because it wasn't their money, and yet somehow it ended up not being kept in the safest possible form and being used as a means of making extra money for the brokerage firm, in this case MF Global. And it's not an uncommon phenomenon. I mean, I think you have all this kind of a daisy chain type investing activity going on in the financial world, where money that should really be held to be, in a very safe position, is not, because regulators are not doing their job, and mainly because that Washington's been bought. That's probably the primary reason. But the secondary reason is that it's become a very, very complicated system with lots of moving parts. And the smart money, the people who are the ones making those decisions, is where the real intelligence lies, and there's not a lot of intelligence in the regulatory agencies. So, you have the smart people who are gaming the system, and then you have regulators who are not doing what they're supposed to. I mean, that's just a lethal combination.
I'm in actual agreement with you on that. I have friends in Canada who were made whole through their MF Global accounts in 8 days. Anyways, I really want to thank you for that response, by the way. It's a refreshing change from the usual blather that we receive on financial media. Thank you again.
Okay, thanks.
Okay, Michael, getting into kind of the real meat of this topic area, to me, the derivative sword of Damocles that hangs over the global financial system is truly the largest threat. In the most recent Bank of International Settlements report, issued November 2011 for the semi-annual period ending June 2011, the BIS reported total OTC derivatives in excess of 707 trillion notional outstanding. Of that amount, 553 trillion is in interest rate contracts, with a subset of 442 trillion specifically interest rate swaps. Another almost 65 trillion are in foreign exchange contracts. A combined 10 trillion are equity and commodity linked. So that kind of leaves 32.4 trillion in credit default swaps and 45.5 trillion unallocated. 45.5 trillion unallocated. During 2008, during the meltdown, it was widely recognized that net exposure becomes notional, and those numbers I gave you before were notional, and that the real risks are the counterparties being unable to fulfill their obligations. Where do you see the risk of dislocation or cascading dislocations, and what could cause these weapons of financial mass destruction to arm and detonate?
Well, one of the problems with it, and in a way you just kind of indirectly addressed it, is that it's gotten to the point where it's so large and so global and so interconnected between various parts of the financial system and the non-financial system, or the real economy, I guess you could say, that it's actually kind of hard to predict where the real trigger points are. And that was the issue that came up in the, the whole Lehman crisis. And in fact, it brings up an argument that I think, in a sense, it doesn't really matter where the bulk of the risk is. The same way it didn't matter so much during the Lehman era. Once people get to a point where they start second guessing where the problem spots are, then their very actions can actually accelerate a crisis. I mean, if people start to second guess and say, well, I don't trust that bank because they're not telling me anything, then it can actually lead to a cascade that can cause that bank to go under. I mean, the whole thing goes back to the idea of bank runs. Even during the Great Depression, some of the banks that went under were perfectly healthy banks in a sort of general sense. I mean, one could take a cynical view and say no bank is perfectly healthy. But generally speaking, some of them were better, well-run banks, but because there was a change in attitude for whatever reason, there was a change in sentiment. Some depositors decided that they were nervous because they didn't understand what was going on. That induced a contagious effect, made others start to pull their money out. And then all of a sudden, the bank that's reasonably well-run is out of business because everybody wants to get their money out. So I think that's the kind of the overriding risk of the derivatives market is that no one really totally understands what's going on. No one really knows where the dead bodies lie. No one knows the extent to which companies have prepared for adverse developments. So it creates a situation that even the most exposed derivatives players may not be the ones that are most hurt if there's if a crisis unfolds. So that's the first point to bear in mind. The other point to bear in mind is I think it just becomes a tremendous legal mess. Now, clearly, there are those who argue, and I think you noted it as well, that there's a big difference between gross and notional risk under normal circumstances, under gross and net notional risk under normal circumstances. But in a crisis, then all bets are off, and that's one of the things I mentioned in my chapter on derivatives is that suddenly, you can say, well, I have 10 million of exposure on product A with bank A. They have offsetting exposure of 10 million on product A with me, so we're net even. So that's how the sort of optimists, or that's how the sort of regulators look at the derivatives problem. However, in reality, what happens is that both sides suddenly look at go through the element of detail in their deals. Both of them go into sort of cash preservation mode. Both of them call out the lawyers, and both of them, in many cases, we saw this with Lehman, they may not totally understand what their exposure is, who they're exposed to, what their immediate obligations are, et cetera. So all of a sudden, what looked like a net offset position suddenly becomes, well, I'm not doing anything. I'm not giving that guy any money because I'm not sure if I'm going to get my money. And then all of a sudden, you have two counterparties that are financially strained. So I think that's the sort of issue here about looking at it, whether you're looking at the gross amount of exposure or you're looking at net after everybody's supposedly offset their risk. And clearly one element of why you have such large and growing gross exposures is because you don't have an exchange. In the futures market, for example, when a buyer and a seller meet up, it essentially extinguishes the contract. So by the time the futures contract expires, you're down to the point where there's very little outright gross exposure left. In the over-the-counter derivatives market, which we're mainly talking about right now, if people want to offset their position, they take on a new position. If they're long A, then they take on a new short A position, maybe with the same player, maybe with somebody else. So suddenly it's twice as much risk in the system instead of being zero risk in the system. But my view, and interestingly enough, is that maybe the worst issues of the derivatives bubble as I saw them when I wrote my book have been transformed. Everyone's talked so greatly about the idea that, have it all go through an exchange, have everything concentrated in an exchange, whether it's the sort of futures exchange or the stock exchange or some kind of centralized clearing system, and then it'll be a lot better. Then we won't have these problems. But, you're getting back in a sense, you now have a scenario where some of these clearing systems are the equivalent of too big to fail institutions. That if something goes wrong there, I don't know what can go wrong. Black swan, something goes wrong, then that can cause as many problems as you can have with an opaque over-the-counter system, because you suddenly have the whole entire financial system tied into one entity which has financial problems. I'm not saying it's going to happen. I'm not even saying which institution could be affected. But if there's ever a problem with, say, one of the futures clearing exchanges, it could cause tremendous havoc throughout the economy in a way that's similar to the kinds of derivatives issues we saw back in 2008 and 2009. So I do think it remains a big problem. I really don't have any kind of comprehensive sense of where the greatest amount of risk lies. I mean, from what little data I've seen, J.P. Morgan seems to be at the center of the universe in terms of its exposure to everybody else in the derivatives world. Does that mean that they're going to be the ones who pay the piper when the whole thing blows up? I don't know. I mean, some people would argue that they're very close to the government, and that there's an incentive for the government to make sure nothing happens to them. So maybe they won't be the victim the next time things go wrong. But clearly, they are going to be somewhere near the center of that problem when it doesn't begin to unfold.
Yep. I agree. OTCs, just moving them onto an exchange is not going to work. They will have to decrease the massive amounts of leverage that are underlying all of those products, and just putting them onto a clearing exchange is not the answer. There's something else that needs to happen. For now, though, we'll leave those behind, and we're going to turn to Rusky for the final question on this topic area, albeit with a bit of a legal twist.
Okay.
Rusky here. I'm actually asking this question on behalf of our good friend Green Meadow. Catherine Austin Fitz once said that the powers that be need the illusion of rule of law to stand up for business to continue to function. A certain amount of trust in the system, if not in each other, is necessary for transactions to occur. This illusion seems to be breaking down with the lack of prosecutions of the people who created the 2008 crisis and with the current MF Global scandal. How far, in your view, can the breakdown of the rule of law go before we have major blowback that affects business?
Well, in a way, it goes back to I think I sort of alluded to earlier. It goes on until it can't. But I do want to expand on that. I don't think it's just been the issues you described. I mean, look at the whole bailout structure and what happened in terms of the auto industry, for example. I mean, you essentially had decades of contract law essentially overturned by government edict because it suited the Washington to have things go in favor of the automakers and go in favor of the auto workers. To me, that was a very underappreciated element of the change in the perspectives about rule of law. But there's others. I mean, there's clearly a sense, I think you can see it even if you go outside the financial system, the sense that government perceptions about upholding the rule of law, upholding the Constitution, don't seem to be as important as they used to be. I mean, there's all kinds of moves now afoot where people are saying that you can kill Americans or kill that the president can order people killed, and that they can lock people up under certain conditions without trial. All of these things which arguably were the foundation of this country's rise to a great power are just falling by the wayside. So I think rule of law is not just applying in the sense of the financial system. I think it's applying in many, many more aspects of everyday life in America, and it's pretty frightening, to be honest with you. But I guess my perspective is that like all of these things, and to be honest, I got a little bit lucky in terms of the timing of my book and my first interview. I got asked point blank when I thought things might unfold, and I said, well, I think it might take 3 to 7 years to pan out. And I think that's still probably not that far off the mark. But to actually pin it to the day or the month or even the year, in the case of the issue you just described, or in the case of some of the issues we talked about before, it's hard to say. I mean, part of it's an element of randomness. Part of it's an element of priorities. There may be certain problems that get dealt with quicker because there's a political interest involved, or there's social pressures of some sort or another involved. We have an election coming up, so that may mean that it has certain things will get taken care of and other things will get completely abandoned. So I think it's always hard to know when the jig is up. That said, I do believe that the next leg down in the economy, which I think is already unfolding, as I noted earlier, will be a game changer in terms of in terms of attitudes, in terms of the mainstream media, be a game changer in terms of the attitudes of the man on the street, be a game changer in terms of perceptions about certain industries and certain businesses, because people will say, wait a minute, you told us it was all going to be better, and I went with you. Fool me once, shame on you. Fool me twice, shame on me. And I think that kind of perspective is going to come to the fore when and if I'm correct, that we have another leg down coming in the economy, and people are suddenly going to be in much better shape than they were before. They're suddenly going to be realizing that a lot of people came out of it, the crisis, smelling like roses and didn't suffer, and yet average Americans are going to be suffering twice because of the sort of first downturn and the second one. And I think there'll also be a lot more instability, a lot more agitation for change coming up through the through the sort of the lower ranks, through grassroots, and I think those efforts will have more power, will have more electricity, will have more enthusiasm, as people essentially find themselves in serious trouble economically. So I guess my answer is that I think it's sooner than we think, but I couldn't tell you exactly when that point of recognition will come that we've all been cheated, and that we've all that one of the things that we held as being very important in this country, the rule of law, has been lost, and whose fault is it?
I think your point about GM was actually a really good one. I thought it was rather odd how the equity holders were essentially made whole while the bondholders, something unmentionable was done to them. Anyways, thank you very much for a wonderful response.
Sure.
We are speaking with Michael J. Panzner. You can help support him by visiting his website, financialarmageddon.com. At his site, you can review his thoughts on economics, finance, and the whistling past the graveyard that passes for financial reporting on financial mainstream media. Shifting gears once again, we'd like to explore your view on the dollar and gold. And for the first question in this section, we're going to again turn to Ruski. Ruski?
Okay, this question is from our friend Pref1 IDIIT. Per our research, I seem to recall that you predicted under one possible timeline that the US dollar could actually increase in value. Given the massive virtual fiat dollars monetary increases we are currently undergoing, coupled with the BRICS, Brazil, Russia, India, China, and their allies moving into a non-US dollar value exchange, Do you still believe that the U.S. dollar can actually increase in purchasing power under some circumstances?
Yes, I do. In fact, as one of the things I should note is that my background includes 25 years in financial markets, mainly involved in trading. And I think that in any kind of environment, you may have a long-term view, but your long-term view can be tempered by short-term developments. And in fact, if you've ever seen a sort of a chart which sort of maps out a secular trend versus a cyclical trend, you can have up and down markets within a long-term uptrend, and you can have up and down markets within a long-term downtrend. And my perspective on the dollar is that although I believe it's fundamentally doomed in the longer term, in the short run, actually, you have some elements, a number of elements that can contribute to a significant rally. And in fact, I expect over the next year or two to see a pretty decent rally in the dollar. I mean, I don't have a crystal ball. I could prove to be wrong, but part of the reason is that I believe that the next leg of the downturn and the continued unwinding of the financial crisis, which has been delayed by misguided Fed and policies and Washington policies, is going to be a scramble for dollar assets to meet the obligations that they built up during the boom years. The reality is that having been the world's reserve currency for quite some time, most of the financial institutions around the world have had tremendous dollar lending programs. I mean, the dollar has been lent out by all sorts of institutions. And as we saw with the financial crisis in Europe, one of the interesting mechanisms that came up was the Fed arranging swap lines. Now, what are swap lines? Well, they are a way for the Fed to give central banks, in this case in Europe, access to dollars to meet a need within that region. And one of the reasons there was a need is that you had a number of banking institutions which had made big dollar loans, were having financial difficulties, and needed access to dollars to essentially make sure that they could continue on those, to continue to fund themselves properly under the circumstances. And the point I'm trying to make here is that I think a dollar rally will stem from fallout from the financial crisis and from the fact that there's a tremendous built-up of debt obligations in the system that are priced in dollars, which as they are unwound, as defaults take place, as the financial crisis carries on, will create a short-term demand for dollars. So I think that will be the driver. I do think that arguably, whether you accept this logic or not, it really doesn't matter. But I think some people will argue that the U.S. is the best of a bad lot if Europe really heads south, if China's economy continues to head south, which it appears to be doing. You may find a scenario where people say, well, Asia's in big trouble because of China, Europe's in big trouble because of the sovereign debt crisis, America, well, they're muddling through it at the moment. I'm going to keep my money in the U.S. And that, in a sense, will be based on a false premise, in my view. But, false premises don't matter when it comes to investing. I mean, people had a false premise about the dot-com stocks during the late 1990s. It didn't stop them from going up to begin with, and going up rather dramatically, in fact. So the fact that people were wrong didn't matter as long as they were putting money behind their wrong views. And I think in the case here, people will be betting that the U.S. is, in relative terms, a little bit better off than everybody else, on top of the fact that you have this technical shortage of dollars, which is going to create demand from the banks around the world.
Yeah, it's a reverse beauty contest, I guess, for currencies, kind of like our national politics. Anyways, over to our good friend McLaren.
Thanks, Ruski. This question is going to be from SHTF Reality, and he asks, Ben Bernanke recently spelled out several downfalls to a gold-backed currency and claimed that there was not any plan for a return to gold backing. Bill Still, of Money Master and The Secret of Oz video fame, is strongly against a gold-backed currency, but he also calls for banking and monetary reform. Martin Armstrong doesn't think a gold-backed currency is viable either. However, Jim Rickards, the author of Currency Wars, sees it as Plan B, though it would never be admitted to by the central bankers. There are also the so-called modern monetary theory adherents who are also against a commodity-linked money of any variety. What are your thoughts on monetary and banking reform? Is it needed, and how could or should it be conducted?
Well, I think it's probably self-evident that there's some reform needed, clearly, because the system hasn't worked the way it should have up till now. But my view is, and my view, maybe you call it a cynical view, but it's certainly based on history, there won't be any real reform until we get a full-fledged crisis. So in the same way that countries which had experienced hyperinflation didn't really change their ways until they hit rock bottom, or like an alcoholic doesn't tend to sort of stop being an alcoholic until they've hit rock bottom. I think the same applies to making necessary reforms, whatever that system happens to be, whether you're talking about a financial system, whether you're talking about a political system, whether you're talking about a social system, whatever. Typically, in my reading of history, and in my perspective on how things have played out so far, people only make changes, particularly when you have a scenario where there's so many vested interests who are in favor of keeping things the way they are. But people only make changes when they're forced to. And in my view, we've come nowhere near the point yet where people will be forced to make changes that are better for everybody in the long run.
Yeah, one of those truisms of history is that every fiat currency that's ever created has failed. So I guess we'll find out when the time comes.
Right.
Giuseppe is up next.
I'm going to read a question for SHTF Reality, and here it goes. I have heard you support the idea of a potential valuation of gold in the area of 5,000 to 10,000 per ounce. Do you still support such an idea? And if so, is this going to happen in the next 5 to 10 years? Or are you claiming this as a potential future scenario? What would the rest of the global economy look like should gold go to such prices in the next 5 years?
Well, I think my time frame on gold is probably more 5 to 10 years. Actually, again, going back to my perspective on being a trader versus an investor, looking at a cyclical trend versus a secular trend, I think gold will actually get caught up in a sell-off as the dollar rallies and as there is a scramble for liquidity in the sort of pure sense in terms of having actual cash on hand. However much people want to look at gold as money, and I think there's certainly an argument there, the reality is you can't go in the store and spend it, and you can't pay off debts with it, and you can't do a lot of things with it that you actually need currency, whether it's fiat currency or not, where you need currency. And I think we're approaching a time in the short run where even gold could suffer, and other precious metals, but gold in particular, as a result of a demand for liquidity and a demand for cash to meet all sorts of pressing needs. So, my view is I think gold could go under $1,000, but I do think 5 to 10,000, 5 to 10 years out from now is immensely doable. And what are the implications for a world where gold is at that price? Well, I guess you better use some of that gold to buy bullets, because the truth is that it will reflect an environment where things have gone totally to hell, and I think that is the outcome that we can expect to see down the road. Now, will it be a sort of a scenario where people are running around in zombie-like fashion and killing each other? No. But I think the model here, and one thing I have changed slightly over time, is I think it could be a steady deterioration. where crime goes up dramatically, but the fabric of society just steadily deteriorates. I think what's happened in parts of Argentina is probably a good role model for the kinds of things that can happen here and in other developed countries, where gold becomes a hiding place for people to put things, because it's difficult to put the money in real estate, because you can have people steal it from you or the government take it from you. It's difficult to put in other kinds of assets because they face similar threats, but there's maybe a better likelihood that you can be mobile with it and carry it around and move and keep it safe in one form or another. But my general belief is that the world is going to steadily deteriorate. Conditions are going to deteriorate. In some parts of the world, social and political instability is going to be pretty ugly. In the U.S., it will probably be spotty. Some places will be better than others, but I see the America of the future is a lot different than the America of the past.
Thank you.
Sure.
With all of these threats and uncertainties, we'd now really like to explore your perspectives on the potential fallout from these rising discontinuities. And you've mentioned the social unrest. In the fallout section of your book, you bring in the social and geopolitical ramifications of the economic and financial dislocation you see coming. While not receiving broad media coverage, socially, there is an increasing evidence of broad social discontent with the policymakers, be they political and or technocratic bodies, central banks, and the financial class. The Greek, Irish, and Spanish society are pushing back already. In your view, will this come to the USA? And if so, what would it take to get the people to stop watching American Idol or sports on Sunday, and push back against the kleptocratic plutocracy of the oligarchs?
Well, I think the answer to your question is obvious. I do think it's coming. I certainly think that there are reasons why, and perhaps it's just because America has been lucky, and people of this generation, most of the people alive today, have only known onward and upward, and have only known things to work out in the end. So once the recognition takes hold that that's not the case and that they are losing out in one way or another, then clearly that will have an impact. And some have argued, in fact, I think is a good point, is that although America may be slow to come around because people have maybe gotten a little bit of fat and happy and complacent, that it goes back to the saying, and I think applies in this case, that is it better to have loved and lost or to never have loved at all? And I think the issue in America is that people are so used to having certain things that it could be much more depressing and much more socially debilitating for people to find things that have been taken away from them than, say, in a country in some parts of Europe where things have never been that great to begin with, and now they're just worse than they were. And I think that is an issue, an underappreciated aspect of what could happen should things go wrong in the U.S. Again, we are still in relative terms one of the richer countries in the world. Will we, become the modern day equivalent of what's going on in Greece? Probably not. But will we look like a much different place than we were even a decade or two ago? I think so. And will we have the kinds of troubles and kinds of disruptions and kinds of social conflicts that other countries that have financial problems are facing? Absolutely, in my view, I think that's a given. I think the other side of it is, there's different parts, different aspects to social instability. I mean, I think we could have a serious crime problem in this country in a way that people have really not experienced for many number of years. Security and safety, in fact, were big topics of my second and third books. I think it will, in fact, if you're looking for an area, a growth area, anything to do with personal safety, corporate safety, security of any form, whether you're talking about protecting resources or you're protecting, life and limb, will be a huge growth area, in my view, in America and elsewhere. So I guess my point is that, yes, I think those things are coming. Exactly how they play out, I don't know. Which places will be most affected? Well, I think we've already seen, as I noted earlier in the program, in places, certain parts of the Midwest, for example, we're already getting some element of anarchic behavior. And I think that those are likely to continue to be hotspots in the same way that the Middle East has been a hotspot for any number of years. It will continue to be one in the future. I think you can make the same statement about social instability. Places that seem to have a propensity for it will probably still have a propensity for it going forward. In terms of the fallout from that, well, one of the things I think is, again, underappreciated is that you're going to have a lot of different elements pushing for different things. You're going to have people pushing for stronger central government, people pushing for stronger state government, people pushing for no government. This is going to be conspiring with pressures between groups. I think there's going to be a tremendous uptick in all sorts of xenophobic perspectives, anti-immigrant behavior, religious resentment. I think religious clashes will become much more widespread, and not just versus the Muslims, for example. I think other groups, Christians and Jews. I think everyone is going to feel the heat in one form or another as we move forward in the years ahead. So that is coming together with the economic pressures, and in a sense the other issues which I didn't really address so much in Financial Armageddon, but one of the ideas I think is important is that we're living in a world of resource constraints where food, energy, water, and certain strategic minerals are harder and harder to come by, and people who need them don't necessarily have them and may do whatever it takes to get them. So again, all of these, in my mind, add up to a much more unstable world and a more unstable U.S.
Yeah, the certainty of the 20th century versus the uncertainties here in the 21st century, I think, will definitely play out, whether they are social, financial, economic, political. It's going to be a very different world going forward. Giuseppe has another question for you, Michael.
Sure.
Michael, this question comes from Brennan. Would a financial Armageddon be a triggering event for the National Defense Resources Preparedness Executive Order resource grab?
Well, I wouldn't surprise me. Sorry, was that the end of your question?
Yeah, there's a little more to it, if you don't mind.
Okay.
And, I'm not sure if you could answer one and then the other. I'm gonna ask the question anyway. What can we expect from the government and establishment in the event of economic collapse?
Well, I think the move you just described is part of a more broad-based stripping away of our civil liberties. I think that we've seen over time that America has gone the way of other great powers. That once there's a sense that greatness is being lost, that power is being lost, that there's a self-preservation aspect to government, which isn't necessarily for the good of the citizens who live in that country. We've seen all kinds of laws get either put in place or, thrown up as a trial balloon that are attempts in one way or another to control or limit behavior, to be in a position to take things under certain circumstances. And I think that was the law, the statute that you just referred to. I think those things are potentially all going to be used at some point, and that is going to be at the heart of some of the conflicts that take place in this country, because there's going to be an argument that says that people are going to say, I'm not going along with it, and I don't support it, and I'm going to fight back against it. So I do think that they do represent legitimate and real threats. The government either taking or interfering in taking things or interfering in lives in a way that has not happened, at least not happened so much in our lifetime. And I think that risk is not just in America. I mean, I think you're seeing similar kinds of programs being implemented in other countries. Clearly, although the motivations are somewhat, although they're somewhat motivated by the private sector, all the rules that are constantly being thrown up in terms of trying to control the internet and trying to control what kind of information passes around the internet, I think those are part of the same process. Clearly, in some cases, you have the intellectual property industry, Hollywood, et cetera, trying to change things to their benefit. But I think it's underneath it, there's the sense that governments want to be in a position to have more control over what people do, what people have, and what people think, and what people say at some point in the future. So that's a pretty scary kind of development. But in terms of what the people's response will be, I think it will, if history is any guide, it's somewhat predictable. You're going to have those who argue that things are out of control and we need a stronger government, and you're going to have those who argue that governments failed us, which brought us to the point of things being out of control, and the last thing we need is a stronger government. So you're going to have really a sort of a social conflict about how important government should be in people's lives. I mean, that's just going to be one of the elements creating friction and one of the elements creating, sort of political instability down the road.
Michael, would you say, instead of having talking about the fallout, would you say, instead of having like a Mad Max scenario, wouldn't you think that people's ingenuity in general would bring us out of such a scenario, of such a fallout?
Well, I mean, one of the things, that question was posed to me in different ways over the course of time. And one of the best arguments you could make about the world we live in is that, we've been through the Civil War. I'm talking about America. Obviously, there's been other things, but we've been through the Civil War. We've been through World War II. We've been through the Great Depression. We've been through a number of scenarios that could have led to the end of the world as we know it, which is obviously is a common expression now. And yet, somehow, after it was all over, people muddled through. And in some cases, after the Great Depression, America emerged as a stronger country than before the Great Depression. Yes, it's possible. But, my view is that there is a number of cross currents that are coming together in a negative way that will make it very, very difficult. For all the sort of benefits that the world has seen from growth in China and growth in India and growth in the other emerging markets, for all the benefits, you certainly have a lot more people in very populated countries who want to have the same things as Europeans have or Americans have, cars, et cetera. So there's just been this tremendous uptick in per capita consumption of all sorts of goods. And, the point here is that, at least from what I've seen, is that there's a mismatch now between this phenomenally growing demand and what's actually available. And that's why we have, one of the reasons why oil prices have been so strong is because you have this, huge increase in demand for oil in China for industrialization, because a lot more people are buying cars, a lot more people are spending money on building housing, etc. So I think that's one of the issues that makes it much more challenging is that we are somewhat constrained in terms of the resources that can allow people to keep on going. The other argument against innovation is that we have had in a sense, even if innovation works, if you're talking about the way the world's infrastructure has been developed, it's very, very dependent on cheap energy, very, very dependent on petroleum products in particular. So, yes, could people come up with solutions to alternative fuels, for example, or come up with alternative ways of generating energy? Yes. But we have this tremendous infrastructure built up that it would take so much money and so much resources and so much time to change, to adapt to an entirely new structure that I think it would make it very, very, very difficult to solve the whatever issues we had in the short run. So we could go through a period where it takes 20 years, but those 20 years are 20 years of hell. Before we actually get to a point where things actually human ingenuity and innovation did what people said it would do. So I guess my view is that okay, let's assume the optimists are right, but if we have 10 years of hell ahead of us, it's still not going to be a very pleasant experience. That's for sure.
Michael, thanks for your view. The next question is going to be asked by Shibumi.
Hi, Michael.
Hi.
What actions can the middle class take to generally protect themselves and their finances in a restructuring collapse situation?
Well, I mean, to be honest with you, the answers are probably not as sexy as some people out in the market might claim they should be, but it really boils down to a reorientation, a change in perspective. You have to look at it and say, is the world going to be the same kind of world that I lived in before? I don't think so. Are we coming to a scenario where your potential job situation, or your earning capacity is going to be adversely affected? Probably. Are you at risk in certain kinds of investments of losing your money? Very likely. Are you exposed to great risks in the short run by having too much debt? Probably. So all of that should be a sort of guiding light. So what does that mean? It means you should be focusing on some way of protecting your assets by holding, at least in the short run, assets that are relatively better than others. Is it the ideal time to be investing in the stock market, which depends on underlying strength in the economy and which has demographic winds at its back and which to a certain extent is been puffed up by policies that are unsustainable? Probably not. Is it a good time to be buying long-term Treasury bonds because they are, backed by the U.S. government and maybe they're the best of a bad lot? I don't think so. I mean, maybe it makes sense to buy short-term Treasury bills, for example, as a place to keep your money. Does it make sense to sort of target more of what you make towards paying down debt and having less exposure? Makes a lot of sense to me. The other possibilities are thinking about what are you going to do if you lose your job? What are you going to do if interest rates go up, which I believe they will go up? What are you going to do if somebody in your family gets sick? So thinking about having more rainy day reserves is one approach. Thinking about learning new skills is another approach. Thinking about generating new streams of income is another approach. Can you sell off things that are really not that important now, that are gathering dust, and that actually could give you extra resources at your disposal if you need them? That's the other thing. A lot of people have come to live in a world where they expect the good times are going to carry on, so maybe they have too much in terms of do they need 2 cars or 3 cars or whatever? I mean, do they have all this space that they live in that they really don't need? So I think it comes down to a sort of a reassessment of what's important, what do you really need, and what happens if something goes wrong. But in terms of actually naming a specific investment, can't sit there and tell you that you should be buying X and selling Y, because I don't think that it's going to remain static. I think it's going to fluctuate. I think, my background as a trader, I think there will be times when you want to buy things and sell things, but you want to make sure you can get your money. But if you're talking about somebody who's just trying to sort of orient their lives to a dramatically more dangerous and more downbeat economic environment, then I think you need to think about the sort of bigger picture of your life. Where's your money? What can you do if things go wrong?
Okay, very good. Now, I sort of have a question that's related to that. There are people out there who do have cash assets, and what do you think is the safest place for them to be to protect and even possibly grow those assets, or is that just an insane thought?
Well, it's not insane, and I'm sure there will be some opportunities along the way. Look, I mean, even in the absolute worst case scenario, even let's just say, if you take history of the stock market, even though the sort of stock market was down dramatically in the Great Depression years, 80% from peak to trough, not all stocks were down 80%. So, excuse me, and some people actually made money betting on the short side, and I'm not saying that's a tactic that your average person should engage in, but there are sort of diamonds in the rough on occasion. But I think in terms of looking at it from a realistic perspective, you should have enough resources at your disposal that if something went wrong tomorrow, you could survive for at least some period of time without being able to find another job or another source of income. In terms of investments, well, whatever I might think about the government and whatever I might think about the banking system, those are probably going to be the last to go. So in the short run, as long as you have a FDIC, you're within the FDIC limits at a very large bank, or you're in the Treasury bills or something with the U.S. government, you're probably okay in the short run. I mean, is that an absolute certainty? No, I don't think there's any absolute certainties, but that's where I would lean.
Okay, thank you. Now I have a question for Plain. What do you see as the end game scenario?
Well, it's going to be multifaceted. Let's put it that way. But the most important thing, I think, and in fact, it's a comment that I've made to people on more than one occasion, is that question your assumptions about where you think the world is. One of the things that should have been taught to people, and again, surprisingly, not too many of them learned, is that no one thought it was possible that we could have a financial crisis equivalent to what we had during the Great Depression. Well, the fact that we did should tell you right then and there that the risks of something really bad happening are a lot more than we thought. That's the first thing. The second thing, to think about is, the idea that everything you take for granted, perhaps you should question whether you should take that for granted. Should you take for granted that your employer is going to be in business tomorrow? Should you take for granted that America is going to be the superpower that it was? Should you take for granted that our political system is going to remain the way it was? Should you take for granted that the dollar is going to remain the world's reserve currency? I don't think any of those things really can be taken for granted. And in fact, as we talked about sort of over the course of this discussion and in my books, many of them shouldn't be taken for granted because it's not going to happen going forward. But the end game for me is that I suppose when I originally wrote my books, I thought the scenario would play out in a way that would be much more frightening and much more impactful. I think now, as I've sort of seen what's happened in the country, as I've seen what happened in other countries, I think it could be more of a gradual deterioration, more of a sort of life becoming more and more difficult day by day, rather than a sudden dramatic change in circumstances. And I think that's the sort of outcome I see. I do think that certain parts of the country over time. If you're in some parts of the country, you're going to find that there's a gradual exodus. The certain parts of the Southwest, for example, are going to become ghost towns. I think more and more people will be moving towards cities, or at least mid-sized cities, and you'll find more and more people not interested in buying cars. I think we've already seen that with young people, and not interested and interested in a different kind of a lifestyle. There's a whole load of conclusions you can draw, but I think apart from that, I do think the most important thing probably for Americans is think about the fact that the safety and security that you think you've had for now won't be there going forward. And there's a real risk, I've said this a couple of times, there's a real risk sometime in the next 10 or 20 years of a global war. I certainly think there will be regional wars sooner than that. And that together with social instability, together with increased crime, all of those add up to a world that's a lot less safe than it used to be, and I think that's an important consideration.
Okay, thank you very much, Michael.
Okay.
And for
Michael?
a final question, we're going to turn to John Ruski.
Michael, that was a very good response, by the way, and I concur with your view that the world will become a lot less safe. But let's see if we can perhaps wrap this up on a more positive note, in the sense that if you were advising a young adult on career choices and places to live, what would you recommend to them? What would you suggest that they do?
Well, like most things in life, it's a bit like me telling my kids what to do. I mean, they're going to do what they want to do. You can offer some advice. I do think that, in terms of lifestyle choices, that it will make sense to find areas where other people are drawn to because they have, decent resources and they're not overly crowded, urban centers. I think people should think about looking at careers where perhaps they resurrect some old-time skills. I think there will be a lot more localization than we've had in the past. People will be more dependent on their communities, so that means that they'll require more people with skills. I think learning the kinds of skills that have sort of disappeared, whether you're talking about craft-type skills or carpentry-type skills, or those kinds of things may be useful to think about. But I think, probably an important lesson is to think about, is there a way that you can make money? Is there a way that you can live by your own means, entrepreneurial? I think that I would encourage people to think about entrepreneurial pursuits, because I think it'll be much more difficult to get a job in the traditional sense than it used to be. I certainly think there'll be some industries that are have a future, although again, they may have a future, but they still would have potential potholes for investors. But, all kinds of energy-related areas are likely to have continued support going forward. If you come up with the way to generate electricity cheaper than it can be done with petroleum, with oil and natural gas, then I guess you're going to be a very wealthy person, as long as the government doesn't take it away from you. But that's I think thinking about industries which will become harder for people to rely on in their current form is one way of putting it. Like I said before, I think looking at areas that could benefit from increasing social instability, areas that could benefit from a world where borders are closed, where there's less cooperation from nations, better ways to be more efficient, ways to manage waste better. There's a number of areas, if you think it through, that could do okay at a time when the world's going to hell. But as to what's the next big thing or what somebody specifically should do, well, at the end of the day, people do what they're going to do.
Thank you, Michael. That was a good response.
We have been speaking with author, analyst, and financial blogger Michael J. Panzner of FinancialArmageddon.com. Thank you very much for sharing your time and thoughts with us today. On November 21st, 2002, when Ben Bernanke gave his deflation, making sure it doesn't happen here speech, not many believed the future chairman of the Federal Reserve would actually deploy digital dollars and buy toxic securities or issue guarantees worth some $16 trillion a mere 6 to 6.5 years later. But he did. Some of us remain firm in our resolve that all Ben has accomplished is kicking the financial Ponzi can down the road, and that a return to normalcy of the past decade's bubble days, be they in equities, bonds, or housing prices, can only be seen in the rearview mirror. The financial world is filled with perils and opportunities. The risks and threats facing the global economy, financial markets, and our well-being are greatly influenced by perceptions, machinations, and influences that are often difficult for the experienced and educated professionals to fathom, much less the layman, casual observer, or the average person contemplating their financial future. We hope the listeners have gained insights into the topics we've been discussing, and we hope you enjoyed it as much as we did. If you didn't, look in that Keynesian rearview mirror for those hours and minutes. You won't find them out the front windscreen. On behalf of Fox and all of the members of Time Monk Radio, thank you very much, Michael. And in our tradition, may you and yours have many tasty pies to come.
Thank you. Thanks for having me.
Thanks, Michael.
Thank you, Michael.
Thank you, Michael.
Muchas gracias.
Thank you. Thank you.